The federal government has a $7,500 tax credit that's available to consumers that purchase either electronic vehicles or hybrids. But what most people don't realize is there are certain restrictions on who qualifies for the credit, as well as the type of cars that qualify for the credit. And the new kind of curveball that's been thrown to us in this year, August 2022, Congress just passed the Inflation Reduction Act, which changed a lot of the rules around this EV tax credit. In some ways, it made it more expansive, but in a lot of other ways, it made it more restrictive as far as who's going to qualify. So we're going to cover those items today. This new legislation changed a lot with these EV tax credits that we're going to cover. So some of the things we're going to look at are the new income limits for claiming the credit, the limits on the actual purchase price of the car to qualify for the credit, the types of electronic vehicles and hybrids that will qualify for the credit, strategies, whether you should buy your EV in 2022 versus 2023 or beyond, the tax documents that you'll need to file with your tax return, and also the state EV tax credits that may be available to you. For this Inflation Reduction Act, some of the new laws do not go into effect until 2023, while others don't even go into effect until 2024. So knowing that these new rules are coming, if you're looking to purchase an EV, again, you're gonna have to decide, should I purchase it before we go into 2023? Should I wait until 2023? Or do I even wanna wait until 2024? Under the old rules, the only thing that was available was that $7,500 credit on the purchase of new EVs, where under the new legislation, they actually created a credit for purchasing used electronic vehicles and hybrids, and that credit is up to $4,000. One of the biggest changes that Inflation Reduction Act will make to this credit is they are now imposing income limitations on who qualifies for the credit. Once you make too much, that credit is no longer available to you, or previously, there were no income limitations. So these income limitations will be put in place starting in 2023, and here they are. So if you are a single filer, you have to make under $150,000 in modified AGI per year to qualify for the credit. Married filing joint, you have to be making under $300,000, and single head of household under $225,000. Those were the income thresholds for qualifying for a new EV for the full $7,500. There are different income thresholds if you're going to be purchasing the used EV for up to the $4,000 credit. And those income limitations are single filers, $75,000 or below, married filing joint, $150,000 or below, or single head of household, $112,500 or below. Again, if you're sitting here in 2022 and you know your income is going to be above those levels and you want to purchase an electronic vehicle, that could be an incentive to purchase the vehicle before 12/31/2022, so you're still eligible for the tax credit under the old rules. It's important to know that not all electronic vehicles and hybrids qualify for this special tax credit, and the new legislation that came through just created a whole new basket of criteria to qualify which vehicles will count towards the credit. Under the old tax credit rules, once a manufacturer sold over 200,000 EVs, they were no longer eligible for that tax credit. So some of those car manufacturers that got cut off were Tesla, GM, and Toyota. Once they sold over 200,000, the people buying those EVs weren't eligible for the tax credit. The good thing is this Inflation Reduction Act removed those caps. So starting in 2023, people will be able to purchase Tesla, GM EVs again, and then qualify for the credit. A new limitation that will go into place starting in 2023 is a limit on the actual purchase price of the vehicle. Once the price of that vehicle goes over a certain price, it will no longer qualify for this EV tax credit. And the limitations are going to be for sedans, it's $55,000, and for SUVs, trucks, and vans, it's $80,000, and it's based on the manufacturer's suggested retail price. The new legislation will also limit the number of cars that will be eligible for this credit because they have new requirements that says the assembly of that EV has to take place somewhere in North America. If it's getting assembled outside of North America, it's no longer going to qualify for that credit. They also have a criteria for the batteries. If certain components of that battery or the assembly of that battery is happening outside of North America, that car will not qualify for the credit. Now, instead of you having to do all this due diligence on batteries and assembly, most likely there's going to be websites that will list all the cars that meet the criteria that will still have the credit available. A quick note about leasing vehicles. So some people lease vehicles and some people buy vehicles. If you lease a vehicle, you don't technically own the car. The manufacturer does. You're just basically borrowing it. So you do not qualify for these tax credits. Only the buyers of cars will qualify for the $7,500 EV tax credit. To bring all this together, starting in 2023, to determine if you're going to qualify for this EV tax credit, it's going to be based on your income, it's going to be based on the purchase price of that car, and it's going to be based on where that car is assembled and where the battery components come from. On the positive side, one thing that the Inflation Reduction Act did change was the timing of when the credits will be received. So as it works right now, and as it will still work in 2023, you have to buy the electronic vehicle, there's no tax credit immediately, and then you have to wait to file your taxes, and that's when they determine whether or not you're eligible for the credit. The way it will start working in 2024 for all those EV purchases is that credit can be advanced at the point of sale, meaning when you buy the car, they can either discount the car by the credit, or it's expected that people may be able to use that credit towards the down payment on that new EV vehicle. But I see some complications here, because if they're advancing people the tax credit and these credits are income-based, they could advance someone the credit. They might end up making more than they expected that year, which then disqualifies them from taking the credit, and then they owe it back to the IRS. The one item that they did not change about the EV tax credit is it's still what's called a non-refundable tax credit, which means if you don't have a Fed tax liability of at least $7,500, you will not be able to use the whole credit. You lose either a portion, or if you have no Fed tax liability, you could lose all of it. So you have people that are expecting to get this $7,500, but they realize, hey, my Fed tax liability was only $4,000 for the year. The max you can get is $4,000. They don't send you the extra $3,500 over and above that that's still due to you. That's considered a refundable tax credit. So we have these situations with clients that are calling us saying, purchase this EV, did some tax estimates. I don't think I'm going to be able to qualify for the full $7,500 in free money. What should I do? And it's almost backward tax planning. Normally, you're trying to find ways to reduce your federal tax liability. In some of these cases, people are going to be looking for ways to increase their Fed tax liability. The other unfortunate stipulation is this is not a carry forward tax credit, which carry forward means if you don't use a credit or a deduction all in one tax year, they allow you to carry the extra over to the next tax year and hopefully use it against future income. This is a non-carry forward. So again, use it or lose it. If you don't use it all in that year, it's not going to get carried over to the next year. Now, if your plan is to intentionally increase your Fed tax liability this year to use up more of that credit, how do you do that? Well, here's some general ideas that we've counseled people on. So the first is, if you're contributing to a 401k, 403b plan, and you're making pre-tax contributions, that is actively reducing your income. We've had some that we've said, hey, stop making pre-tax contributions in your 401k account because that will increase your Fed tax liability. The way you can shift is instead of stopping completely, you may want to shift from pre-tax contributions to Roth contributions within the plan, which means you're not shorting your retirement. You've just kind of shifted the source because Roth contributions are made with after-tax dollars, so it doesn't reduce your income, but you got to just check to make sure your plan allows it. And it gets more tricky than this because if your plan has a matching contribution, which means you have to put in money to get their money, and let's say it's a dollar for dollar match, it may not be worth losing that free money from the employer to help increase your Fed tax liability to qualify for more of the credit. So you really have to do a thorough pros and cons analysis before you go that route. A second strategy is find a way to put more income into the current tax year. If you're a small business owner and you have some control over when you realize income, you may want to realize more income to get your tax liability up to that full $7,500 threshold. If you're a W-2 employee, outside of the 401k stuff, if you have a good relationship with your employer and you have a bonus coming and they can either pay that bonus in December or January, you may want them to pay it in January. If you need to increase your Fed tax liability for the year. The flip side of that is looking at the tax deduction side of things. If you're a small business owner and you can push some of those deductions in the following year, which gives you more income this year, that may be a strategy. If you're a W-2 employee, you really have to be itemizing to really kind of play with the deduction scenario to kind of say, do I want to potentially take these deductions this year or next year? The next one's a fun one, but it's when do I get married? So if you didn't qualify for the tax credit as a single filer, and let's say you were planning to get married at the beginning of next year anyways, maybe you push the marriage up by a few months. Now you've got the joint filer and you can qualify for the full $7,500. Nothing says I love you like a big federal tax credit. Up until now, we've been talking about the federal EV tax credit, but depending on what state you live in, there may also be state credits available to you that have different criteria. One of my clients called the other day and said they bought an EV and they were wondering, how do I go about applying for this tax credit when I file my tax return? There's a special form that you have to file with your tax return called an 8936 form, and I'll put a link to it in the description below. I hope this was helpful. If you have any questions, please feel free to reach out to me at moneysmartboard.com. Thank you.